Hello and welcome to this month's edition of the Research Roundup from Fidelity Digital Assets. My name is Chris Kuiper, Director of Research, and I am joined once again by my intrepid colleague, Jack Neureuter. Jack, kind of a quiet month in terms of digital asset price action, but no shortage of things to talk about in news. So we're going to hit the action fundamentals, talk a little bit about Bitcoin hash rate and what's going on in the mining world, some Ethereum updates, and then macro backdrop and digital assets as well. So all charts today, or for this roundup, not a lot of specific news we're going to cover. So let's get into it right away with the price action. So looking at the 1-year returns, we're now coming up on the anniversary of the all-time highs hit in Bitcoin last year in November. So not surprisingly, our chart is looking pretty ugly. It's about as close as you can get as the drawdown from the all-time highs of around 70%. And Bitcoin and Ethereum about keeping pace with each other here as well, which is interesting. I think on the next chart here, we have the Bitcoin versus Ether market cap. And anything to point out here, I know we've talked about this before, hitting that resistance and just not finding some escape velocity for Ether in the past few months.
Yeah, I mean, I think we'll probably talk a little bit about some of the issues in the Bitcoin mining space. But, Ethereum was pushing up against this resistance going into the merge. There was a lot of hype around it. And then it ended up being sort of a sell the news type of event where it was rejected against this sort of 50% relative market cap of Ethereum to Bitcoin. And I think that you're starting to see it potentially revisit that resistance again because of this discussion we'll have around mining profitability and some of these miners running into liquidity issues and having to sell Bitcoin, while at the same time slowly over time the reduction in issuance of Ethereum has a meaningful impact on flows, at least in the short term here.
Yeah, absolutely. And we're recording this on Friday, November 4. We've actually got quite a big move in Ethereum versus Bitcoin today. So we'll keep an eye on that and see if it continues. All right. I mentioned this briefly, but quiet front for Bitcoin. We've actually seen volatility come down. So this is Bitcoin's 30-day volatility versus its price. And a couple things stand out on this chart to me. Obviously, aside from the massive spike in volatility with the COVID sell-off there, along with the markets. But number one is, if you look to the far right, that blue line, we are at a very, very low point here, almost as low as we've been in recent history. And a lot of journalists are pointing out that on some metrics, if you look at, say, the 20-day, which is a little odd, but nonetheless, if you take shorter time frames, Bitcoin's volatility is actually less than the S&P 500, which is pretty amazing, given how volatile it's been in the past. And some people are pointing out that, oh, this is a great thing because volatility is usually cited as a big impediment or headwind to investing in this space. It keeps people out. We'll talk about our institutional survey. It was, once again, the number one cited concern or barrier to entry for people, volatility. But we wouldn't point that out too quickly here, because a lot of times what this means or what happens is volatility gets compressed and then it explodes once again. And if you look over its history, you can kind of match up where volatility hits lows, and then you look up above in the chart and it's either exploding to the upside or to the downside. And more often than not, it's gone to the upside, but obviously past performance is no indication of future performance. We could go either way here. And so I want to just point that out, that this isn't exactly a reason to say this is the new normal. If we look at the past, this is probably an indication of kind of this ball being held under the water, an inflatable ball, and then all of a sudden it gets let go and shoots up one way or the other.
Yeah, I can't help but think, is there any impact from prior to the summer when we had the blowups of various leveraged entities, and now it seems that there might be a decent bit less leverage in these markets at the moment, and a lot of this consolidating without as many traders that are trading on high margin levels that could be susceptible to liquidation.
Yeah, we talked about that last month too, with the futures and how much is now margined with stable coins rather than the actual tokens like Bitcoin itself. But one other thing I've been keeping an eye on, which could kind of set the stage for volatility to explode higher again, is Bitcoin's liquid versus illiquid. And you can take any number of measures here. We look at just what's moved in the past year or hasn't moved in over a year, and you can see the dramatic decline in the liquid supply and the dramatic increase in the illiquid supply. Now, just to point out, the y-axis on the left there, it does only go down to 30%, not zero. So we're not trying to commit any chart crimes here, but we just wanted to show the relative move over the past couple of years here. And then, of course, we have to talk about hash rate hitting all new highs once again. This has been an incredible thing to watch. We've been mentioning it a few times just because it's so odd for the hash rate to be going up continually while the price of Bitcoin goes down, because usually these two things are function of one another. If the price of Bitcoin's going up, that induces miners to plug in more machines because their margins are increasing. They want to get that more valuable Bitcoin. But of course, we've seen the exact opposite. What can you tell us about what's going on here, or how this might play out, or what we've already seen?
Yeah, I mean, my overall personal hypothesis in terms of why are we seeing hash rate continuing to just run higher and higher, I think it's mostly around the fact that there were purchase orders that were made, 6-12 months ago for the newest, best possible, most efficient equipment. And therefore, they're sort of just getting a lot of those orders filled, all sort of at potentially the worst time, right? Because everyone's getting access to those that new equipment all together, which is great. It's more efficient. You could potentially have a more profitable machine. But now the price of Bitcoin is down from those highs at making whatever these lows in the $20,000 range, while new machines are putting online, and that inverse relationship currently that we're seeing is very abnormal, and at some point has to correct itself. Right. And so I think like the next slide we have, if you flip to the next slide, we can see, this is just an estimated cost of production, cost to produce Bitcoin. And you can see historically when we've gone through bear markets that we've gone through, these periods of time where miners become euphoric, invest in equipment, maybe overinvest in equipment, and then we have these like washouts where the estimated cost of production is significantly higher than the price of Bitcoin, and that means that certain miners are going to have to potentially wind up shop and sell that mining equipment to stronger hands.
Yeah, sell the mining equipment, or perhaps, as we've seen, sell some of the Bitcoin that they had been accumulating. I think you've got this on the next chart here. What's this showing, and what is this telling us here?
Yeah, so since everything is pretty transparent and open source with Bitcoin, it's rather simple to be able to tell where the mining rewards are going, and then if we sort of know what exchanges look like, through software such as Glassnode, being able to say, okay, this looks like a certain exchange, and that entity looks like another exchange. We can see the flows of miners, whether or not they're holding on to that Bitcoin or they're sending it to an exchange to presumably potentially sell that Bitcoin in order to fund their ongoing costs to continue to mine and keep their operations up in liquid. And we're seeing, if you look at the right side of the chart, most recently is that there is a net reduction in Bitcoin held by miners, which means they're sending those assets to exchanges to presumably liquidate them and fund their expenses in fiat.
Yeah, and so we also have the publicly traded miners who report their holdings, so we can track that they've also been selling, right? And surprisingly, a lot of them have already sold a lot, in my opinion. I mean, there's still a lot on the balance sheet that could come to the market. But when I look at those numbers, I don't see them as significant or dire as people say. So in other words, what I'm trying to say is it seems like we've seen a lot of the capitulation already with miners selling their accumulated Bitcoin. And so the recent news flow of some of these miners having financial difficulties and people pointing to that, saying that's going to put additional sell pressure on Bitcoin, I'm not so sure. I think we've already seen it. It's just we haven't seen it come to light until now. But I don't know if you had any different thoughts there.
No, I agree completely. But the one thing that I think that this gets worse if hash rate continues to stay at its elevated levels and we still have the macro headwinds at the moment. I think a lot of these miners right now are saying, hey, we got to liquidate some of this supply of Bitcoin that we have to hopefully continue to live to fight another day. kind of thing, where as long as the price recovers at some point or hash rate starts to curve down, well, then all of a sudden we become profitable again. And, whatever, a few months from now, maybe conditions are better and we can continue operating, and we don't have to, go through bankruptcy or something like that. And to your point, we saw that a lot of this Bitcoin, on some of these, most leveraged miner balance sheets has already been liquidated throughout the summer.
Yeah. So certainly we don't like to see the pain, but we also can see how these markets kind of equilibrate, how the hashing and difficulty adjustment works into this, and things will come out on net as they always do, but in the short term could see a little more pain. So that's a lot on Bitcoin. Let's turn now to Ethereum. Obviously, we had the merge. Probably the most remarkable thing is that big fireworks didn't happen, or things didn't break as some people may have thought they would have. So it went off without a hitch, and now we are in this new era. What are we watching now? What are you looking at now, Jack, as you see this new era for Ethereum unfold?
Yeah, so I think we've spent some time talking about the fact that with the merge comes, you remove miners from the equation, and therefore there isn't this high ongoing cost that you always have to make sure that you're bootstrapping with an inflationary reward, right? Because if we think about something like Bitcoin, you do need that subsidy, especially in the beginning when you don't have as much network activity, in order to fund mining operations sustainably over time. And so Ethereum removes that, and then at the same time is able to reduce its issuance rate by 90%. And I think we've talked about that a lot. But one of the other things that we maybe haven't talked about as much is the growth in supply of ETH staked, and then sort of thinking about in the future, what could potentially happen. Because right now, ETH staking ratio, there's 15 million, almost 15 million ETH staked on the Ethereum Beacon chain. There's 120 million ETH total, and you can see here the staking ratio, 12, 13% of total supply. But if we compare that to the other major proof of stake chains by market cap, the vast majority of them have 50% or more of their supply staked. And you have to ask the question, well, why is that not the case for Ethereum? Well, one of the big things at the moment is if you stake on Ethereum's Beacon chain, you're waiting for an upgrade in the future to be able to actually withdraw those assets from your validator. So it's in a liquid position, and you have to basically just be okay with the fact that you don't have access to those assets until at some point this next set of upgrades, the Shanghai upgrade, takes place, and then you have liquidity. And so I think there's a decent chance that once you see that upgrade, you'll see a lot more supply of ETH staked. And although I think that ETH staking rate might be lower than some of these 70% numbers, just because there's more applications and use cases on Ethereum, and we see a lot more higher network activity, and so people want to actually use that ETH. But I still think the potential for a double or triple over the next whatever the 6 or 12 months following the actual network upgrade that allows liquidity of staked ETH is very well possible. And then that ETH is less liquid, it's sort of locked up in these validators.
Yeah, so just for clarity's sake, you did mention it, but staking ratio, you're talking about the percentage of Ether that is locked up and staked with validators as a percent of the total supply out there, and
Yep.
corresponding for everything else. And then when you said double and triple, you weren't talking about the price, obviously, of Ether. You were talking about doubling or tripling of the staking ratio, I assume.
Yeah, exactly. Like, I don't think it's crazy for Ethereum 6 months after you actually have liquidity to see that 12% be more like 30-40% 6 to 12 months after that upgrade takes place.
Yeah, and I had one question of why Ethereum's so low, and you mentioned one reason being that you still have them locked up until the Shanghai, so it's illiquid. Is another reason, though, just simply that it started as proof of work and now it moved, so some of these other networks started as proof of stake from the beginning, so things were locked up, or am I off there?
Yeah, no, I think that's definitely a valid point as well to be made. That and sort of like I'd mentioned, like there are a lot of use cases and applications on Ethereum, and so I do think that you'll probably see a lower staking ratio. Also, in terms of like the actual inflationary rewards, like the cost benefit of holding Ethereum that is not staked isn't as expensive as it is on some of these other chains that have really high inflationary rewards that only get paid to stakers. And so there's like a high hurdle or incentive to be staking versus just holding ETH. The opportunity cost is higher.
Sure, makes sense. Moving on now to this chart here. What are we looking at and what's going on here?
Yeah, so this is just sort of relating to the last point, is to say, as a percentage of circulating supply, what is ETH being used for? And in each of these cases, one, ETH being sort of locked up as some form of collateral in smart contracts, or two, being used as a yield-bearing asset or yield-bearing collateral on the Beacon chain in a validator, combined to be roughly 40% of ETH circulating supply. And then again, if you sort of draw that logic out, if ETH staking becomes liquid, that number could double or triple. Combine that with the fact that smart contracts or usage of DeFi applications has sort of tapered off during the bear market, and if on-chain activity returns, there could be potentially more applications and more assets locked in those applications. And so you're starting to talk about if the bear market subsides and you get these network upgrades, more than half of ETH supply is sort of locked in various places, acting as a productive asset, and that sort of has a few different implications. But one of the biggest being just the fact that there's less ETH that's sitting on exchanges and constantly being traded.
Yeah, exactly. All right, so we'll end here with some macro updates. We've talked a lot of how macro continues to be in the driver's seat for digital assets. So we would be remiss if we didn't talk about it on Fed week here, big week from the Fed. Obviously, the 75 basis point increase in interest rates was as expected. The markets were actually up a little bit once the press release was announced. But then when Jay Powell started talking, markets turned down sharply as he made a lot of hawkish comments. So again, macro continues to be in the driver of markets, but surprisingly, Bitcoin did not go down as much as the markets did. I think yesterday or Wednesday, when we had the Fed meeting, markets were down. I think NASDAQ was down 3% by the close of the day, and Bitcoin was still pretty flat. So to me, that kind of gets to one of our hypothesized theses or questions, that Bitcoin and other digital assets kind of front ran a lot of this bad macro news and tightening. And so it really priced in a lot of that stuff. Again, going back to our first chart, we're down 70%. So there just wasn't a lot more to fall there. But I didn't know if you had different ideas or comments there, Jack, or if you wanted to explain what we're looking at here, a chart that you've put up before on Twitter and we've talked about as well.
Yeah, no, I agree with that observation. Definitely in terms of crypto potentially front running a lot of the carnage or damage that's taken place in macro. But beyond that, if we look at sort of this chart, particularly on the right side, the past 3 months, you'll see that although everyone's citing the fact that backwards looking inflation is at these really elevated levels, the fixed income market is not pricing in forward inflation expectations in the long term to be like materially higher. Right. And if we look at the past 3 months, that green line has only moved up 19 basis points. It's about 2.5% is the 10-year annualized expectation of inflation. 2.5%. That's not that crazy. That's not that far from the 2% mandate. Meanwhile, what are the backwards looking numbers? 8%, right? 8% plus. But if we look at the change in interest rates as a result of a lot of Fed policy, right? Quantitative tightening, reducing the balance sheet, combined with the rate hikes on Fed funds, you can see that nominal rates, the black line, have moved up 122 basis points, and so the net effect to real interest rates has been positive, over 1% positive. And that's really, a really strong change when you think about convexity and the fact that you're going from a sub 1% real interest rate, and then over the past 3 months, more than doubling it. And so it gets at like the macro headwinds are still very much here at the moment. And if this week's press conference was any indication, they'll likely continue to be here for the time being until we get inflation data that looks good in the Fed's eyes.
Yeah, absolutely. And this is a thing we come back to and we hear from a lot of people. I thought Bitcoin and some of these other things were supposed to be inflation hedges, and they are. If the market is predicting low inflation, by relative standards, 2.5%, then it's less attractive, right? If real yields are going up, we have to be honest. Something like Bitcoin is less attractive because it doesn't have a cash flow, right? The question is the market correct, or is this going to be the same story over the long run of 5, 10, 20 plus years? And that's where we won't get in today, but that's where we've gone into. Ultimately, we see inflation staying around because this debt has to be inflated away. It's kind of the standard playbook of central banks around the world right now. But in the short to intermediate term, these assets are acting rationally, right? They're forward looking, they're not backward looking, and you can't deny that real rates are going up, and the market does think the Fed is going to get inflation under control.
Yeah.
I think we have one more here. I think you touched on this a little bit, but if you want to add anything here, feel free to.
Yeah, no, it's just to build off of that last chart, which is to say the blue line here is the inverse. If you look at the right-hand side, it's the inverse move in real interest rates. So as they go more positive, the opportunity cost of allocating away from certain assets or the discount rate on other assets rises. And so you would expect headwinds to be there for Bitcoin. And as the chart sort of shows, since October of last year, real interest rates have sort of gone in a straight up direction, and the price of Bitcoin has gone sort of in a straight down direction. And we don't think that's necessarily a coincidence. It's actually markets acting quite rational.
Yeah, absolutely. All right, so we're going to end here. We're going to plug two things. Number one, Jack, you've been a Twitter maniac recently, putting out a lot of these charts and more. Where can people find you on Twitter?
Yeah, that's at J_Neureuter, first initial, last name.
Awesome. And then the other thing we wanted to highlight once again is our latest annual survey is out. So this is our 4th annual consecutive survey. Once again, over 1,000 institutional investors that we survey. You can find that on our website at the address there. Or if you just go to fidelitydigitalassets.com, it should be up there as well right now, or click on the research tab at the top to stay up to date with all of our latest research. Thank you again for tuning in, and we look forward to seeing you next month.